Welcome to the Jay Martin Show. If you're new to the channel, my name is Jay. I'm an investor just looking for the smartest home for my cash. If that sounds like you, I think you're going to like what we do here. Now, my guest today is Louis Vincent Gave. He's the founder of Gavekal Research, an investor, money manager, and brilliant mind. I love when I get the chance to speak with Louis, and today was no exception. We covered a ton of ground. We began talking about rates, energy, and inflation. We used that to segue into the de-dollarization of certain economies around the world and how they are intending to manage this and the implications of that. We talked about de-globalization and why Louis says that's the wrong word. This isn't de-globalization, and the winners of this, not de-globalization, but similar, are not going to be the US, not going to be China, not going to be Russia. It's going to be the countries on the margin, the Indonesias, the Vietnams, the Mexicos, the Brazils. Very interesting perspective, and I always appreciate his take and his time. I know you're going to love this one. As always, right beneath this piece of content, there's a link where you can subscribe to my weekly newsletter. I publish every Sunday. I absolutely love writing it. Over 40,000 investors hear from me each week. I get great feedback as we dive into the biases, heuristics, and blind spots. I'd cover investor psychology in my weekly op-ed, and I love writing it. Also, special announcement, in response to the overwhelming questions we've had from subscribers over the last 18 months, asking, how do I get started investing in the commodities industry? We've put together a 10-chapter video course called The Commodity University for anybody who's beginning their commodity investor journey. We start with the absolute fundamentals and get all the way through to portfolio construction. Hit up thecommodityuniversity.com. We're launching this course in a couple days. I'm super excited about it. Here is Louis Vincent Gave. Enjoy.
This is Jay Martin.
All right, here I am with Louis Vincent Gave. Louis, it's great to have you back in the program. I appreciate you making the time.
My pleasure. It's good to be here. I'm noticing you don't have my book behind you. I need to send you a copy.
You do, all 9 of them, Louis. I'll put them in their own shelf here, man. I'll do it.
Nice. I'll do that.
You know, that's a separate conversation. I'm so curious how you find the time to write so much, given your work and like your travel schedule. Right before we record, I think you listed 3 continents you had just gotten back from over the course of the summer. But how you find time to write so much is very impressive, my friend. Very impressive.
In the plane, right there.
On the plane. Okay. Yeah. All right. Hit airplane mode and go for it. Okay. I'm looking forward to chatting with you today. A handful of directions I want to go. I figured since today, just for context, is September 20th. And, we had a rate announcement today, or sort of non-announcement, I guess you'd say. They're holding rates steady. Let's start with that, because I've noticed a shift in the sentiment from the guests I have on my show over the last 6 months. Now, what I mean is 6 months ago, everybody seemed quite certain that the Fed was going to pivot, within 18 months or something like this, like near term. And it wasn't so much a matter of if they would, it was a matter of when. And the when always seemed to land within like a year or two. But I'm seeing that conversation evaporate a little bit, and the higher for longer conversation is becoming more dominant. I had a great chat with Jim Grant last week, and he walked me through, his thoughts on rate cycles and how they tend to move almost generationally, like 40-year trends, and that any hope of a return to zero the next couple of years is just false. But where do you land, Louis? What do you think?
Well, let me first say you're very lucky to get Jim Grant. I think he's one of the not only one of the smartest brains in the world of finance. I think he's probably the best writer in the English language alive today. I whenever his newsletter drops every 2 weeks, I drop everything and read it. So I didn't know you interviewed him 2 weeks ago, but I'm going to go out and look for that interview. And now I'm sort of intimidated to come right after Jim to talk about the same topic, because obviously Jim Grant has forgotten more about interest rates probably in the past week than I could hope to know in a lifetime. So look, my take on interest rates is actually pretty simple, and that is that we're now in a structurally higher inflationary environment. And I think we're in a structurally higher inflationary environment, not by accident, but by design. The Fed has, 800 economics PhD who work there. I think most of them knew that if they ran M2 growth for 18 months at 26% year on year, while simultaneously running budget deficits of 8, 9, 10% of GDP, that, these are the conditions where you're always going to end up with inflation. And so here we are. Now, the Fed, I think, wanted the higher inflation. It didn't want the 8%. It wanted the 3, 4, 5, because that's how you deal with the overhanging debt issue that we have in most Western countries today. When you look at debt to GDPs of over 100%, the only way you get that ratio back down is either through some kind of default and restructuring, which is not doable, or you eat away at it through inflation, which was the history of the 1950s, 60s, 70s. Through that period, inflation was always structurally higher than interest rates. And I think that was the where the Fed wanted to go to. They went too far. Now they've got inflation sort of back to more reasonable levels of 3, 4%, which is where they really want to be. Now they can't come out and say, hey, we really want 3 or 4% inflation. They're going to keep pretending and say, hey, we want 2%. But really, I think they're more or less where they want to be. So I think the Fed is pretty much done here. The only question, open-ended question for me is, do we get a fiscal tightening looking ahead or not? Do we continue to have full employment in the US with budget deficits of 8% of GDP, which, if you told me that a few years ago, I would have said that was not mathematically possible, but yet here we are. Do we continue having basically governments that spend money like drunken sailors on shore leave? And if we do, then inflation, central banks, will be hard pressed to keep inflation below 4 or 5. If we get some kind of fiscal tightening, which right now there's absolutely no sign of, to be very clear, then you can hope that inflation goes back to the 3%. But yeah, I think the Fed is pretty much done. It's itching to declare victory, and or basically pass the buck now onto the governments and say, look, monetary policy's done the job. It's now up to fiscal policy.
So am I jumping to a conclusion then when I just make the assumption that because energy prices are climbing right now and the Saudis and the Russians extended their cuts and the shale is kind of rolled over a little bit, that we can just expect higher prices of everything, 6 months down the road, because oil is the one input required for anything that you want, whether you're growing, manufacturing, et cetera. Would this not point to general inflation, 1, yes, 2 quarters forward, 3 quarters forward, and then if the Fed says we want 2%, but we're sitting at 3 or 4 now, energy prices are climbing, inflation should climb, a few quarters later?
Absolutely.
Okay.
No, absolutely. My starting point in all my research is that economic activity is energy transformed, and that, the price of energy matters tremendously. Now, I think what you're seeing right now is the consequence of many things. So you mentioned, of course, the geopolitics aspect of it, what Saudi Arabia is doing, what Russia is doing, and that's, of course, of great importance. But let's not kid ourselves that the creep higher in energy prices is also the direct consequence of our own energy policies over the past 10 years. For the past 10 years, we've promoted investments in alternative energy, and we've penalized investments in carbon energy. Now, 10 years later, we've spent $4 trillion in wind and solar, and we've gone from 83% carbon base to 81% carbon base in our mix. So that $4 trillion has been basically pissed away. It's been capital malinvestment on an epic scale. And how do you pay for capital malinvestment? I think typically it triggers inflation. If you make a bunch of investments, you waste capital on things that aren't productive, which is exactly what we've done on energy. Down the road, you pay the piper. And this is where we are today. We're now in the phase of the cycle where investors are realizing, oh my God, all these productivity gains we hoped for in alternative energy, they're not there. And so you're seeing an absolute collapse in the share price of anything linked to alternative energy. And on the other side, a rise in the energy prices. As I think it's dawning on market participants that, we've made ourselves a pretty muddy bed, and now we have to lay in it and sleep in it. So you're absolutely right that the energy equation is the one big stumbling block on this view that, oh, well, maybe inflation goes back down to 3% and we sort of muddle through and the Fed won't do very much, and we can, get on with our lives. That's why I've argued, and I think I argued this in our podcast we did, what was it, 6 months ago, maybe? And I've argued in any podcast that I do that the ultimate diversification for your equity portfolios, your listeners may like Microsoft, or maybe they like Alibaba, maybe they like LVMH, whatever stock they like. In the old days, you bought a bond to hedge against uncertainty. You bought a U.S. Treasury, you bought a Canadian government bond, you bought a German bond to hedge against a potential shock. Forget that. Today, you need energy positions, because the big Damocles sword hanging over our heads is that energy prices spike up. So, you might have the companies that you like, the investments that you like, but what will completely derail your investment thesis is if oil goes to $150. And please note, I'm not saying oil is going to $150. I'm saying that's the risk today in the market. It's a risk that is very high given the malinvestments we've made on the energy space. It's a risk that's very high given the geopolitical situation right now. So you need to cushion your portfolio against an potential oil spike to $150. And again, I'm not saying it's going to happen. I'm saying that's the risk you're running.
What are the preventative steps? Are there preventative steps, better question, that the US could take to protect energy prices from getting that high? We can drain the SPR so much. Is there anything else at their disposal, Louis, that would strike you as significant?
Well, the SPR is back to the level it was in 1986, when global oil consumption was less than 2/3 what it is today. So, the ability of the U.S., I think there's about 350 million barrels left in the SPR. You need to keep at any one time 200 million barrels. Like, that's sort of your bare minimum in case, you have hurricanes, a war, whatever. Like, you don't want to go below 200 million. So really you're dealing, and by the way, you're at 650 million a year ago, right? So you've right. already drained 300 million over the past year. You can probably do another 150 million. So at the current pace, it probably gets you through the next 4 or 5 months at the current pace of releasing, because they're releasing between 30 and 50 million barrels a month. So come the end of this winter, or even the middle of the winter, if you continue to release at this point, you're done with the SPR. So yeah, what can you do? You can try to mend your relationship with Saudi Arabia. But I think right now Saudi Arabia has little interest in talking to President Biden. Granted, if tomorrow, President Trump comes back, President Trump and MBS have a very close personal relationship. So Saudi Arabia could be leaned on at that time, potentially. But that's not for another 15, 16 months, right? First, you need the election, and then you've got the transition. So, what else can you do? You can, stop the sanctions against Venezuela, but there again, it's not like Venezuela can just turn it on. You have no more oil engineers in Venezuela. You have no more oil platforms. To be honest, I think the lowest hanging fruit if you're the US and you start worrying about the oil price is you stop being such a knucklehead and you actually approve the Keystone pipeline. And you do everything you can to bring more Canadian oil into your own market, because that is the one part of the world where perhaps you can crank up production somewhat decently quickly. It's right here in Canada. You still have the oil engineers, you have the infrastructure, you have a sound legal system where you can feel comfortable deploying, quickly hundreds of millions, if not billions of dollars to crank up production. But there's really no sign of that happening. So, the risk, again, it's a big Damocles sword over our heads.
Yeah, it's almost like there's a couple of problems politicians have to face both in Canada and the US now. And it's a problem that they created by villainizing the oil sector so much over the last 5-10 years, right? It's almost like nuclear 10 years ago, and they've made these promises. Now they're backing out of them. Okay, so
Well, on this, I was told, I don't know if it's true. It's probably not true, but I was told that there's a plaque in the German Defense Ministry's office that says never again will we fight a war on two fronts, um, because fighting wars on two fronts is it's a recipe for disaster. I think in recent years we've decided we're going to fight a war against the Russian, we're going to fight a war against the Chinese, and we're going to fight a war against climate change. And we're going to do all this while also basically snubbing Saudi Arabia and the UAE, and telling them that we don't like them, because the whole mantra of the Biden administration has been that, and it's humanly it's a worthwhile mantra, but their mantra has been that there's two kinds of countries. There's democracies, and the US can be friends with democracies, but if you're not a democracy, then the US has no interest in being a friend with you. That's been the mantra, the foreign policy driver of the Biden administration, and it's beautiful, it's idealistic and everything, but the reality is, we live in a world where a lot of the oil is produced in democratic countries. It's produced in Saudi Arabia, it's produced in the UAE, and so it's like, how many fights do you want to pick at the same time? And you have to prioritize your fights. In World War II, we decided, we, the Western world, we're fighting Germany, and we did a deal with Stalin, and we did a deal with Mao to fight Japan and to fight Germany, even though Stalin was definitely no choir boy, and neither was Mao Zedong. But here, I think there's a certain level of hubris where we think we can take on all these challenges all at the same time, with fairly little consequences. And I think this year is the year where we're finding out that actually we can't. You have to pick your battles. You can't fight every battle at the same time.
I publish a weekly newsletter every Sunday. If you would like to subscribe, hit the link right beneath this video. Now, I'm an investor, but I don't write about managing money. I write about managing my mind. Without question, the hardest and most important part of allocating capital through volatility and getting some back. If you want to read my newsletter, hit the link right beneath this video. I know you'll love it. Now back to the interview. Enjoy. Yeah, I can't help but assume or think that part of that is a symptom, specifically in the US, of an election cycle every 2 years. You can't fight all these challenges at the same time. Well, you're never actually going to fight them, right? You're just making promises to get reelected. You're thinking in 2-year time horizon. It's very short. And so, of course, you promise the world. You promise all kinds of things because chances are you're not going to be the one who's going to have to deliver. I mean, in Canada, it's kind of that way. It's we're making promises for 2035 and 2050 that Trudeau's not going to.
It might, it might be. You know what? From your lips to God's ears on Trudeau not being there, but the in terms of is it linked to democracy? The U.S. has always had this system, and I think the U.S. was better in the past at picking and choosing its battles. I'm not sure it's linked to democracy per se, as the old story that absolute power corrupts absolutely, and for a long time the U.S. was the sole unipower in the world for a period of 25 years. And during that period, you learn to not compromise. You learn to, it's my way or the highway. And you learn, I think the hubris just ends up feeding on itself. And now, the bill for that hubris is coming due.
What do you make, sticking with energy here, what do you make of Russia's plans to sell gas to China at 50% the cost it will sell to Europe?
Look, I think economic activity is energy transformed. That's the starting point of a lot of what I do in my research. And if you start off with that idea, whoever has the cheap cost of energy, it doesn't mean that they win, but they start off, ahead in the global economic race. Now, if you start on that premise, the past 15 years, the U.S. had a massive comparative advantage. And that comparative advantage was, with the shale revolution, the U.S. had cheap natural gas, plentiful oil, and a cheaper cost of energy than anybody else. So, the chemical industry moved to the US, and anything that was energy intensive moved to the US. Now, what you're now seeing is as you project yourself forward with these kinds of deals, I think in the future, it will be, or in the coming years, basically the message that Russia's sending out is, look, whoever's willing to trade with us will have a cheap cost of energy. In fact, even stronger than that, not only will we sell them cheap energy, but we'll sell them energy in their own currency, which is, the biggest comparative advantage there is, right? At being able to buy and settle your commodity needs in your own currencies basically means you get them for free. If you're China, you can now buy your oil, your copper, your iron ore, your natural gas in renminbi. You can always print the renminbi. So all of a sudden you have no more constraint to your growth. Same story if you're India. Same story if you're Indonesia, Brazil. All these countries that are now buying fertilizer and coal and whatever else from Russia and paying for it in their own currency. It's a game changer for them. It's an absolute game changer. So to answer your question today, everybody is bared up as can be on China. China's supposed to be imploding. Like hardly a week goes by where you don't have a cover of The Economist, Business Week, et cetera, telling you China's imploding. Meanwhile, if you take a step back, you think, hold on, China's energy costs are collapsing even as everybody else's are rising, number one. Number two, China's trade surplus has just gone from 30 billion a month to 80 billion a month, as it buys more and more commodities from Russia in its own currency, and that Russia then has no choice but to use that money to buy things made in China, whether cars, earth-moving equipment, etc. So China's trade surplus goes ballistic. To me, that doesn't spell immediate doom. Now, this isn't to say that there aren't challenges in China. There's big challenges, but let's take a step back and take a deep breath. Countries who get cheaper energy and who run trade surpluses of, almost $1 trillion a year, $1 trillion. If China's trade surplus was a country, it would be in the G20, to put things in perspective. Like there's only, right, I think 18 countries that have an annual GDP of over $1 trillion. China's trade surplus is $1 trillion. So, it's China already has some comparative advantages, but the fact that it now has cheaper energy than everybody else, that's all the more so.
Yeah. I mean, it kind of brings us back to the front end of this conversation. The price of energy determines the price of a lot. The deal makes sense Absolutely. To me from a Chinese standpoint, because yes, you can sell oil and gas to the Chinese for renminbi, turn around and buy whatever Chinese goods you might need, which is a lot, rare earths, whatever. But what are you supposed to do if you're sitting on a pile of rupees or Indonesian rupiahs? Like what happens with that currency, Louis? What do you think is the transaction there, and how do they get that back to gold or back to?
Exactly. I don't know if you saw, but Lavrov, the Russian foreign minister, he was in India. I can't remember if it was June or July, and he made that very point. He said, "Look, we keep like earning all these rupees. We're selling you a ton of oil. We're selling you iron ore. You're giving us rupees. You got to give us something we can buy with these rupees." And in essence, India's answer to this has been, well, it's our currency and your problem kind of thing. And I think here India is being very, very short-sighted, because on the other side, China's done a number of things. First, it's done something that India still refuses to do, which is open up its bond market to foreign investors. So now if I'm Russia and I earn a bunch of renminbi, my first option is I can buy a ton of goods that China produces and that I may want, automobiles, earth-moving equipment, telecom switches, high-speed trains, you name it, China's producing it now. It's no longer just, cotton T-shirts and plastic toys. So Russia can actually, the renminbi they earn, they can actually buy stuff, especially now that, Western companies can't sell their goods in Russia. So, I might, if I'm a rich Russian, I may want to buy a BMW and an Apple phone, but tough, I can't. So I'm going to buy a BYD car and a Huawei telephone because that's what's available. And this is India's problem. India's first problem is India doesn't really produce goods that people really want. So that's India's first challenge. Now, the second thing China does is it says, look, you can buy government bonds or you can buy corporate bonds. And here we have like a deep liquid market where foreigners can now participate. And so if you have too many renminbi, buy bonds. And if you still don't like that, then you can take your renminbi to the Shanghai Gold Exchange and buy gold there. And so all of a sudden, if you're Russia, trading in renminbi is a no-brainer. You have like all sorts of things you can do with your renminbi. Now, what can you do with your rupees? To be honest, with your rupees, you go to Bali and either you buy real estate in Bali or you just have yourself a very nice holiday. And same with the Thai baht. You go to Phuket and you have a great holiday there. And by the way, they are doing that. You go to Phuket today, it's like Russia town. And same in Bali. You go to Bali today, Russians everywhere.
I was there, 9 months ago. That was absolutely the
Oh, you
case.
are?
Yeah,
You were? Okay. Yeah. No. It's like in Phuket or in Bali?
We were in Uluwatu in Bali. Yeah.
Okay. Yeah. Are you a surfer?
A little bit. Yeah.
A little bit. Nice. So tons of Russians everywhere. Now, India, you could say, well, you can go to Goa, etc., but it's not exactly the same vibe. And foreigners can't really buy property there, right?
It's very hard. It's an odd transaction.
Yeah, you can't buy property in India. You can't buy property in India.
Yeah.
But in Indonesia, you're not supposed to buy property, but you can. There's workarounds. You can buy through company structures, and you can at least buy leases.
Okay.
So, but in India, it's not that you don't even have that option. So I think India's missing a great opportunity there, and for now, I think Russia is still, it's a little bit on the ropes. So it wants to sell its oil to India. It wants to sell its iron ore. So it's still taking the rupees. But at some point, it will say, you know what, I don't want to trade with you anymore.
Yeah, it's when you walk through this, I find myself wondering, is this India's problem yet? Because right now it seems like a Russian problem, right?
Absolutely.
And eventually it may become an Indian problem because maybe there's enough buyers of Russian gas, oil and gas, especially if they can convert to gold. And the gold.
I think it's a Russian. I think it's sorry to interrupt. I think right now it's a Russian problem and an Indian opportunity.
Sure. Yes.
And it's been a Russian problem and a Chinese opportunity. And I think China's been quite good at capitalizing on this opportunity. Hence announcements like, okay, we'll sell more to the Chinese and we'll even sell them at half the price. And Lavrov came and gave a clear warning to India, look, like sort it out, or we're going to do less with you. And if India ignores it, they're just going to do less.
Yes. Okay. Now you made a comment. You said the U.S. has been, a unipolar power for about 25 years, or they had been, right? And we're. Is it a given now, from your perspective, that we're in a multipolar world, or is this still a question mark to you?
No, I think we're increasingly in a multipolar world. Absolutely.
Yeah.
Look, you see this. The first place you see this is trade flows. 25 years ago, the U.S. was pretty much any country's number one trade partner. Today, China is, very often most countries' number one trade partner. So you've already had a big shift in trade flows. You're seeing a shift when you look at where global trade is growing. It's all emerging market to emerging market, and it's also pretty obvious that the world, since the Ukrainian invasion, the world has sort of split between a Western alliance that to some extent has come out of this Ukraine war reinforced, and the rest of the world that looks at the Western alliance with a lot of skepticism, and the rest of the world that perhaps no longer sees the United States as the shining city on the hill. I think if you were in Thailand and if you were in Saudi Arabia and if you were in South Africa, I think you always looked to the US and always thought these guys are the smartest guys in the room. These guys, they've got it together. And these were the days of the Washington Consensus. So, you looked at the guys who worked at the US Treasury, at the Fed, et cetera, and you thought, wow, these guys, they really have it together. But following everything that's happened in the past couple decades, I would say that the various U.S. policy mistakes, invasion of Iraq, terrible policy mistake, Afghanistan, complete shambles, letting Americans banks first get massively overextended and then letting them go bust in 2008. It's if you're sitting and looking at this from Indonesia, from Thailand, etc., you no longer think these guys are the smartest guys in the room at all. And so yeah, I think the perception has shifted dramatically.
Okay, so then on the back of that, in the rise of an empire, as I understand it, Louis, often what we see at the super early stages is a surge in investment in education, right? This usually turns into a surge in innovation and technology development, making that nation more competitive. This leads to greater percentage of trade, global trade, and eventually more influence, et cetera. So let me back up here. What's your take if you were to step back and say, in the long cycle of the US empire, when you think through previous empires like the British, the Dutch, the Spanish, et cetera, and then you maybe take what you know about the rise and fall of those empires and lay them over top of the current state of the United States empire, what inning would you say that we're in right now?
I don't know. I
Yeah.
always fall back on Adam Smith's quote that there's a lot of ruin in a nation. I think we first have to acknowledge that, when you look at the US in terms of its geopolitical positioning, in terms of its access to commodities, the US starts with pocket aces. They just have the US comparative advantage are so great relative to pretty much any nation out there. They can't be invaded by anybody. Geographically, the United States is, crisscrossed by rivers that you can navigate. It's got huge advantages of geography. And it's, self-sufficient energetically, self-sufficient in food. It's got so many things going for it that it's, to think that, oh, we're coming to the end of America, to me seems far-fetched. What we are coming to is the end of the unipolar moment, where we had 25, 30 years where, again, culturally, economically, militarily, on every front, the US was so far dominant above everybody else. Like the people didn't even question. It was just so far ahead. So the US was so far ahead on everything. And you mentioned education, and that was another one where the US was, so far ahead. And, you could say, well, US universities are still the number one universities in the world. Like, who wouldn't want to go to Harvard or Stanford, or Princeton or any one of these? And that's undeniably true. And these universities continue to attract some of the world's top talent. But at the same time, you could argue that, US universities are not the beacons of freedom that they used to be, the places where you could debate and discuss anything. In fact, quite the contrary. Within the broader American societies, a lot of the campuses in the US are now amongst the least free places in the US. It's amongst the places where speech is the most controlled. It's among the places where, employees are actually the most afraid of stepping out of bounds of, so it's gone 180 degrees. And against this, if you look at China now, China produces every year more engineers than the US has. And that's including the engineers that the U.S. produces for China, because so many of the engineers, you go to an engineering school at any major college campus in the U.S., and about half of the kids will be Indian and half of the kids will be Chinese. So, I'm sorry, long-winded answer. You don't want to completely write off the U.S., but I think you have to acknowledge that we're coming to the end of the unipolar moment.
Okay. I think that's a super pragmatic answer. I appreciate that. Because I tend to agree. I mean, I interview so many guests from, call it, the precious metal space. There's a lot of doom and gloom forecasts, right? Like, I gotta keep my guards up to make sure I'm not just developing a bias.
Well,
here.
look, if you're selling precious metals, you're selling fear, right?
Absolutely you are.
It's
Absolutely you are. Yeah.
and I often quote the parable of the talents. When I don't know if you know this parable that Jesus gives. Uh, he has three servants. Well, the master has three servants. He gives 10 talents to the first one, who goes out, starts a business, and everything goes well. And the master congratulates him and tells him to, keep the money, and sends him on his way. The next guy lends the money out. He's got 5 talents. He lends the money out, and the master ends up taking the capital back and the interest and says, "Okay, that's fine." And the third guy is so worried that he buries the talent. He says, I don't want to lose it, so I bury the talent. And when the master comes back, I give it back. And that guy, the master punishes. So
Sure.
it's interesting because it's a profoundly capitalist view of how the system works in the middle of the Bible. But in this, the gold bug is the guy who buries the talent. He's the guy who has money and says, "Ooh, I want to keep what I have, and I want to make sure that I get to keep it." When really our job as capitalists should be, how do I grow the system? That's always where we should start off. Not how do I keep what I have, but how do I grow it?
Yeah, that's a fantastic parable. I'm gonna have to look that up, and readers are probably gonna see that in my Sunday newsletter. Sounds like a good one. All right, so let's jump back to U.S. dominance, moving to a multipolar world. We're kind of seeing the term deglobalization gets thrown around a lot right now. Admittedly, I throw it around a lot right now, and I want to get your take on this because I know you don't like that term. You've got some different perspective. I want to talk about if we were to like super high level, maybe discuss how the world is dividing. It's almost like there's two blocks. And one interesting way to sort of draw that divide would be 2/3 of the world condemned the Russian invasion, 1/3 abstained or did not condemn it. And that's one way of dividing the globe right now into what looks like two competitive trading blocks. Now, that's sort of a quick and dirty explanation. Do you see it that way?
If you look in terms of global population, I don't think it was 2/3, 1/3. It was more 1/4, 3/4. The whole global South basically said, "Look, this isn't our fight. We want nothing to do with it." So,
Interesting
China
take. Yeah,
and
absolutely. Okay.
it was the Western world, which is roughly, let's say, 1/4 of the global population, and 3/4 of the global population was like, yeah, countries like Brazil and Mexico that are allies of the United States, they they didn't vote. They didn't vote in the UN. They just abstained. So yeah, I think most of the global South was like, yeah, not my fight. And frankly, now you could say it was very cynical from countries like India. A country like India was quite transparent. Said, hey, if I can get cheap oil out of this, of course I'm going to do it. So, and same story with Brazil, like getting cheap fertilizer. So there might have been a cynical element to it, but yeah.
Or
Now
strategic.
to your point, yeah. No, like Modi was openly said, I'm elected to help Indians in India. So
Yes.
anything I can do to help, I'm going to do it.
Yeah.
That's my job.
Yeah.
And yeah, it's tough for Ukrainians, but I wasn't elected to help Ukrainians.
Yeah.
So you could say it's very cynical, but that's, I guess, when you're a poor country, you don't have some of the moral luxuries that perhaps richer countries have. Now, to your point on deglobalization, I don't know if what we're seeing is as much deglobalization as much as designification. That's the term I like to use, because what we've really seen is an attempt by the Western world to isolate China, to say, look, we can't be dependent on China as we've been. For geopolitical reasons, for economic reasons, for all sorts of reasons, we have to basically cut the links. And I think that when this attempt to desinify is actually been terrific news for a lot of other emerging markets. You've seen, factories leave China for Vietnam, for Indonesia, for Thailand, for Mexico. Now, I would argue that it's been crumbs that have been falling off of China's table, but that if you're a Vietnam, you can have a feast off of these crumbs. And so it's been a key driver of the unfolding boom you're seeing right now in emerging markets. I think one of the more interesting development that nobody talks about is you have all those recession signs in China, all the recession signs in Europe, growing recession signs in the US. Meanwhile, Latin America is booming. The Middle East is booming. India is booming. Southeast Asia is booming. And there's a lot of reasons for that. One of them we've already mentioned, the fact that these countries can now, fund their commodity needs in their own currencies. And that removes a massive constraint to their growth. Another is designification. Every factory that leaves China for Vietnam is a boom for Vietnam. So, these trends are there. They're very strong, and point towards a continuing boom in emerging markets.
Yeah, that's a really, I like that take. I was looking today and I can't recall the number, but the percent that foreign direct investment in China has dropped over the last 18 months. And that's a huge piece of pie to be divided up between, Indonesia and Vietnam, et cetera. Now I'm seeing a lot of, I don't know how to describe, what would you say? I'm seeing a lot of interesting strategic moves in terms of mineral exports right now from some of those countries as well, like Indonesia. They've had a copper ban, a nickel ban in place for a few months now. They're pushing forward a copper ban as well. Malaysia just announced they're going to be banning the export of rare earths. Is this, what do you make of these developments? Because I look at it and I'm like, the world's kind of shifting into a bit of a commodity war, right? And the supply chain of any raw material that any country needs is suddenly uncertain. And so anybody who controls those raw materials is going to look for leverage right now. But what do you make of these developments, Louis?
Look, I agree 100% with what you say. We're entering a world with much more geopolitical uncertainty. We're entering a world with, geopolitical tensions and a new Cold War. I mean, I think we can say it. And, with that comes a need to secure your own supply chain and on almost everything, but commodities first and foremost. And so, at first, that's quite inflationary, of course, for the world. If everybody needs to, if we forego the productivity gains that we had on sharing everything and on optimizing everything all the time, we forego this for security, for increased security. That means more inventories, that means more capital tied up, that means lower productivity. That's the world that we're in. Absolutely. And yeah, countries that have access to commodities will be, I think, in a better spot than those that don't. And
Yeah.
that's why I think if you're Europe today, you're in a tough bind.
Right. Absolutely. Absolutely. Which simultaneously makes me very optimistic. You and I are both in Canada today, very optimistic on the future of Canada. It's a country laden with so many of the resources that the world needs. And when leveraged productively, we, for example, came through the 2008 crisis with a healthier balance sheet than any other G8 nation as a consequence of our resource economy. One thing
all you need is the political will to exploit this.
Yes.
And I think you need the political will to exploit this domestically, which I would argue has perhaps been lacking in recent years. And you need the political will to exploit this on the other side of the border, because that's your obvious market for it. And there, frankly, the U.S. needs to realize that it can't, pick fights all over the world and at the same time poke Canada in the eye like it did by pulling the Keystone Pipeline. It's here you have, a country that's your friend, that shares all the same values, with whom you can do business. It's such a no-brainer. But yet you do everything you can, it seems like, to prevent commodity extraction in that country. It's madness.
Well, I imagine as the supply of raw materials from Russia and China becomes increasingly unavailable to Americans, the supply of raw materials from Canada will climb in value.
They'll have to.
They have to.
Yeah.
They have to. Right.
Yeah.
Right. And our economies, relatively work in tandem, which sort of supports your I don't want to call it bullish sentiment towards the U.S., but your anti-doom and gloom thesis.
Yeah.
Right. Okay. So maybe pulling off of that, what is the competitive advantage of the United States today? Is it their technology and innovation competitiveness? Is it the military? Is it just the world reserve currency? Like, what is the the strongest pillar right now in the United States?
Look, the strongest pillar of the United States has always been that the US has the world's reserve currency. That so much of the global trade, so much of global savings, so much of global working capital happens in US dollars. And even with crazy fiscal and monetary policies as the US has had in recent years, even with that, the US dollar remains the US dollar. And to undermine that now, I do believe we've started a period of de-dollarization, but de-dollarization, it's not a date, it's not a particular event per se. It's a process, and it's a very slow moving process at that. So yes, more of the trade around the world is moving away from the dollar, but a dollar remains a dollar, and that remains the big comparative advantage in the U.S. Of the U.S. Now, this isn't to belittle the fact that the U.S. has great universities. It's not to belittle the fact that the U.S. has great corporate structures, CEOs. Some people argue that one of the best comparative advantage of the U.S. is the Chapter 11 rule. That the U.S. has a whole history of transferring assets from weak hands to strong hands. That people can go bankrupt in the U.S. and start again, and undeniably that's also true. That's also a strength. You have a whole capitalistic ecosystem in the U.S. that's been put together over hundreds of years, or the past 100 years, which allows the U.S. to deal with crisis decently quickly and move on. Transfer asset from one weak hand to strong hands, and keep the show on the road. So the U.S. does have a lot of advantages. I don't want to belittle that. The question is, are those advantages improving or deteriorating? Because markets are made at the margin, and I would argue that at the margin, a lot of the decisions taken in the past couple decades have been perhaps on the wrong side.
I mean, look, first of all, I really appreciate your pragmatic take on the where we may or may not be in the cycle of the U.S. empire. And it's important because YouTube, podcasts, newsletter writers, when the doom and gloom narrative sells really, really well. It's super sticky. It's seductive. And the thing about like crash predictions, I don't know if you've noticed this, Louis, I'm sure you have. You never have to be right? If you're selling a crash as a prediction, people gravitate towards it. And if it doesn't materialize, they forget about it the next day. But if you're right, even if you're right once every 10 years, you're heralded as an oracle, right? Like the so-and-so who saw the XYZ crash coming.
Well, it's the prophet syndrome. Everybody wants to be a prophet. You run around announcing the end of the world, but the reality is, when you manage money, and at Gavekal we do manage money, it's hard to make money on the end of the world. More importantly, managing money, and this is true, when you're betting on a crash, to use a baseball analogy, in essence, you're saying I'm going to hit a home run. You're going to bat and you're pointing at the bleachers, saying I'm going to hit a home run. But the reality of money management is most of the time you're just trying to get onto base. And money management is first and foremost about hitting singles. You hit singles, you hit singles, you hit singles, you get on base, and every now and then you get a fat pitch, and then you can whack the cover off the ball. But that doesn't happen that often. Now, having said all this, I do want to highlight that we're now in the phase of the cycle where mortgage rates are going up and where gasoline prices are going up. And if you look back through history and you look back at periods where mortgage rates have gone up 250 basis points or more, and where gasoline prices have gone up 30% or more in 12 months, it's not a lot of happy outcomes. It's not a lot of happy days. This is a tough combo: higher interest rates and higher gasoline prices. And again, like I don't want to be all doom and gloomish and predicting a crash, etc. But I think we have to acknowledge that making money in an environment of rising mortgage rates, rising gasoline prices is not easy. And I'm sorry to mix my sporting analogies, but money management, I just said it was baseball. It can also be American football, where you have an offensive team and a defensive team. And, when you have rising gasoline prices, rising mortgage rates, I think you want to have the defensive team on the pitch on the field more than more than the offensive team.
Yeah, that's a good actually segue to the last topic I want to cover here, which is, I was going to ask you that outright. Are you playing offense or defense right now? Because, sure, we're getting away from the fall of the empire, but we've probably got some rough times ahead for some of the reasons you discussed. And a lot of the, I don't want to minimize a lot of the micro issues that we're seeing right now, like record credit card delinquency. The auto loan bubble is now the second largest in the United States. Yeah, I'm not so familiar with the United States housing market, but in Canada, it's something now like 38 billion in mortgages that are reverse amortized. So they owe more with each payment they make because of the increase in
Yeah.
rates. And there's a lot of
Well,
this.
I would say all this is a symptom, right? The underlying ills are the rising gasoline prices and the rising mortgage rates.
Yes.
The
Okay.
symptoms, the way it appears, is credit
Mm.
card defaults and auto
Yeah.
loan defaults, and it's those are the symptom of the underlying problem, I think.
Yes. Okay. So yeah, that's great perspective actually. So talk to me about your defensive strategy right now, and where you got
So
capital allocated. What are you looking at?
yeah, so that's a tough one, right? Because historically, for the past 35 years, you could say, oh, well, things are tough. I'll go out and buy a US 30-year treasury and I'm off to Bali to go surfing. And I'll wait this one out. Thank you very much. The problem is bonds no longer do their job. Um, it's been 3 years now. We're looking at a third year in a row where 10-year US treasuries are going to be losing money. Um, Bonds are no longer the anti-fragile building block around which you can build a portfolio. And I think you and I discussed this 6 months ago already. But the simple reality is bonds are not doing their job because we've moved from a structurally deflationary environment to a structurally inflationary environment. And in a world that's where you have structural inflation, finding portfolio cushions to protect your portfolio, again, maybe you like Microsoft, maybe you like Alibaba, maybe you like LVMH. There's like so many great companies out there that you can invest in. But how do you protect against a shock against those? What I've been telling all our clients and what I'm doing in my own portfolio is I think the new anti-fragile asset class is basically the broader energy complex. In that the real risk today to our markets is that gasoline prices continue to creep higher. The real risk to our system is that oil prices go to $150. If that happens, equity markets implode, bond markets implode, and you get another 2022 where you're losing money on both equities and bonds. So today, the real hedge for portfolios is energy. And I would say, on that front, energy in Canada, if our take on geopolitics is right, that at some point the US will have to embrace Canada more than it has, you could get a pretty nice re-rating on a lot of Canadian energy names. So that'd be one place you could look. How do you hedge against inflation? I think the experience of the 1970s beyond energy was that you want to own currencies that are structurally strong, currencies that have the ability to take the inflation hit by re-rating. So, in the 1970s, if you held Japanese bonds, if you had German bonds, if you had Swiss bonds, you actually did very well. Today, don't go out and buy a Swiss bond, don't go out and buy JGB, and don't go buy a German bond. The new bond markets that are performing well amidst this inflationary environment are in Brazil, they're in Indonesia, they're in India, they're in Chile and Mexico, or even in China. In Chile, I was there recently, they call the Bank of Mexico, they call it the Bundesito for Bundesbank, because the central banks that now follow proper monetary policies and the ministries of finance that now follow proper fiscal policies are no longer in the West. They're in the South. It's countries like Mexico, like Brazil. So if you're debt inclined because you don't want too much volatility, if you're worried about volatility, then I would say buy EM debt, and whether in Asia or in Latin America. And so that's how today that I've been adding money into Latin American debt personally and buying more energy.
Okay, interesting. And you mentioned Southeast Asia as well a couple times.
Absolutely.
Okay, very cool. You know, we're putting roots down in Indonesia, more so than just visiting last year. We're going back this year for an extended period of time. I'm not putting
It's a
roots
great
down, but
place.
like,
I
yeah, it's a
love
great
Indonesia.
place. It's a great
I love
place.
Indonesia. I've been a structural bull on Indonesia for the past 20 years.
Mm,
Currency. I mean, back then the currency was more undervalued and bond yields were much higher. Um, I've held Indonesian government bonds for the longest time. I've loved them as an asset class. Um, but yeah, Indonesia is. I think it's a terrific place,
it is. Yeah, it is. Great for kids too. I
especially
got
if you're
three
a surfer.
super young ones. Yeah, and Uluwatu's got some very steady waves. Absolutely.
Yeah.
Um, okay, look, Louis, I want to thank you for coming on and point
Pleasure.
everybody to Gavekal Research. So it's just research.gavekal.com. It'll be in the show notes. You can buy one of Louis' 9 books up there, in addition to a handful of other things. Anywhere else we could point people today, Louis, or anything you want to share about your work?
Well, we have a private wealth arm called Evergreen Gavekal, and we have free newsletters for sort of, because our gavekal.com is sort of more institutional investor focused. It's really a product aimed at institutional investors, but we have a more sort of retail arm with our Evergreen Gavekal. So if you're institutional, go to gavekal.com. If you're not institutional, check us out at Evergreen Gavekal.
Evergreen Gavekal. Okay. Thanks again, Louis. It was a pleasure.
Absolutely my pleasure. Good to see you.
Thank you for tuning in. I hope you enjoyed this conversation. Now, if you want to take the next step, I publish a weekly newsletter and it's free. There's a link to subscribe right beneath this video, and you can join me and 50,000 other investors weekly for this exclusive content where I share my key action items and takeaways from conversations just like this and plenty others. Thanks for stopping by.